Hello, I'm Nathan Kubik, and thank you for joining us for the second quarter of 2019 Carnick Kubik Capital Markets Outlook. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. From a financial markets perspective, 2019's strong start has continued through the second quarter. Equity markets are at all-time highs, and fixed income markets have rallied as well. Both of these asset classes rallying at the same time leads some to believe that there is a disconnect between the equity markets and the fixed income markets. However, we must take into account all of the market's influencing factors. The most pertinent factors of today include the Federal Reserve's discussion surrounding interest rates, the ongoing trade war, and global growth concerns primarily in the international markets. And when we put those factors together, it paints a strong picture for what we're witnessing in the US and international markets. This is true in both the equity markets and the fixed income markets. Domestically, we are seeing corporate earnings continue to grow. The consensus of analysts' expectations sees continued growth in domestic earnings through the end of the year, and that all-time earnings level highs are expected to hit at the end of this next quarter. It is widely anticipated that the Federal Reserve will cut interest rates before the end of the year. For interest rates here, we show it as a neutral factor. Generally, cutting rates implies that the economy needs some help. However, cutting rates does have the potential to boost growth and thus earnings and the markets. We believe that the U.S. economy is strong enough to maintain current rate levels, but given the rest of the world's interest rate levels, other than adding an arrow to the Fed's quiver, there really isn't a good reason to hold rates higher than the market demands. The rest of the world continues to place a drag on the U.S. economy, and the trade order is likely the most influential factor right now. There are reasons to be hopeful that an agreement might be reached, but the future of the trade war remains an unknown. For now, at least domestically, the economic expansion is continuing. A question that is currently on many investors' minds is how long can this economic expansion continue? Unfortunately, there's no crystal ball to answer this question. Some people believe that because this is the longest recovery in history, that it must be nearing an end. Looking at the chart on the left, we realize that while it may be the longest recovery, from a GDP growth perspective, it's actually been the slowest. In fact, in the past, we've seen total GDP growth expansions 2.5 times the current expansion. This recovery has occurred in what we would call a Goldilocks economy. This is an economy that is not growing too fast or too slow. Inflation is low, and there is relatively market-friendly monetary policy in place. It is also important to understand that with the development of cell phones, computers, internet, and other revolutionary technologies, the U.S. economy has changed from a manufacturing-based one to that of a service and technology-based economy. Thus, much of the historical data regarding economic expansion is not an optimal indicator, as it's not truly an apples-to-apples comparison. If we look at where the economic growth has come from, technology is a major contributing factor. In 1990, the technology sector made up just over 5% of the S&P 500. Today, when combined with the communication services sector, it accounts for more than 32%. That is not to say there aren't risks to the expansion ending, but rather that the economy today is significantly different than it has been in the past. Historically, for a recession to occur, there has always been a macro-environmental factor that has contributed meaningfully. As seen in this chart, commodity spikes, an aggressive Fed, or extreme valuations have been prevalent in every recession going back to the late 40s. While we are in an economy with different drivers today, these are all still factors that can contribute to the end of an expansion. Fortunately, we are not experiencing any of these today. There are no commodity spikes, the FAR is far from aggressive, it's actually quite dovish, and valuations are far from extreme, as we will discuss in a bit. Of course, there were other contributing factors in each of these recessions. So let's talk about the most impactful factors we are seeing today. On the positive side, monetary policy, inflation, tax policy, regulation, and interest rates continue to create an environment positioned for continued expansion. While on the negative side, government spending and long-term liabilities are an area of concern. Additionally, the trade war and lower levels of international earnings continue to be a drag on the U.S. economy. We are hopeful that a resolution will be reached on the trade war and that international earnings will improve, but for how long they continue as they are remains uncertain. For now, we believe that the U.S. economy and these positive factors will continue to overcome these negative factors and that the expansion will continue. As we can see, the U.S. has continued to steadily grow GDP, albeit at a rate slightly below historical averages. Again, this points to the Goldilocks economy we've been discussing. And U.S. companies have been able to capitalize on this environment in a meaningful way. Looking at the chart on the right, we see that the U.S. has been able to grow earnings at a rate significantly higher than that of GDP economic growth and of that of the rest of the world. While the trade war with China did have an impact on U.S. earnings, we have been able to resume our earnings growth and overcome that impact. Unfortunately, the same can't be said for the rest of the world. As you can see, emerging markets, Japan, and Europe have not yet been able to bounce back from the impacts surrounding the trade war. Looking at the chart on the left, we see the economic impact to the U.S. from tariffs placed by China. There has been about a negative 1.2% drag on the U.S. economy. This can be seen more granularly in the chart on the lower right, with auto imports being the most impacted area. Now, look at the chart in the top right corner. Here we see the imposed and proposed impacts China has had on the U.S. in the third bar from the left. Looking at the bar furthest to the right, we see that the U.S. is certainly in a position of power in these negotiations. This size, strength, and resilience of the U.S. economy are some of the reasons why U.S. companies have been able to overcome this drag and why other companies have not. Shifting a bit from economic data to actual equity market implications, here we want to look at stock market performance by region. The EFA index is the Europe, Australasia, and Far East. EM stands for the Emerging Markets Index, and the ACWI ex-US is the entire world excluding the US. Let's look at the one-year number first. The S&P 500 returned a positive 8.22%, while the rest of the world returned a negative 1.5%. Looking at the 5-year number, a similar scenario is seen, with the US returning an annual rate of 8.46% and the rest of the world returning a negative 0.47%. Remember that the U.S. equity markets are approximately 40% of the world's market cap. According to Forbes, most U.S. investors have far more than a 15% weighting to international, and that's a number that academic models put around 30%. We have long been tactically positioned out of international and emerging markets, and we continue to look for economic indicators to give us a reason to consider some exposure here. But to date, it is not yet warranted. Last quarter, we discussed our view that the equity markets were appropriately valued, or just a touch over historical averages. We continue to see that going into the third quarter. Valuation correlations within the markets have begun to rise from what are considered lower levels, and the disparities between fundamentals and valuations have begun to align in some specific sectors and subsectors of the market. This coincides with the positive shift we have been watching with investor sentiment. This is not to say we are overly bullish, but we continue to be cautiously optimistic. From a style perspective, large cap growth continues to be in favor. Large cap value has also performed pretty well. We continue to believe that large cap stocks are the place to be and that growth specifically is more attractive than that of value. That said, something interesting has happened in the large cap space that we believe shines the light on an opportunity that we are already positioned for. When a company is classified into a growth versus value style, it goes through a relatively complicated formula that weighs market valuations along with underlying fundamentals. The formula does not change from company to company, and we believe some companies are currently inappropriately classified by the reporting group named Morningstar. There are a number of companies with very strong growth characteristics whose valuations are cheap enough to pull them into the large core style, and for some, even into the large value style. We believe these offer a great opportunity for them to be rewarded with a higher multiple, appreciation in value, and to move back into the growth style category. This can be seen in the chart on the right. By the Morningstar classification, we appear to be slightly tilted towards value, with 33% of the portfolio tilted towards growth and 38% tilted towards value. We do not believe this is truly reflective of our holdings, and we do have our own way of classifying our holdings. As you can see in the bar on the bottom right, we find that we still maintain our overweight to growth. From a valuation standpoint, growth is a touch more overvalued than that of value based on historical reflective levels. But we believe that this is warranted given the factors of interest rate cuts and the continued Goldilocks economy that we are currently in. This is further supported by what sectors are performing best. Technology, discretionaries, and industrials are generally thought of as the growthiest sector, and looking at this sector table, we see that those three are the top performing sectors for the year to date. Our current overweights in our core model are indeed technology and discretionaries. Contrarily, healthcare, energy, utilities, and staples are the worst performing sectors, and while healthcare is historically a core style, the other three are all deeper value sectors. Healthcare is currently out of favor in the markets, but we are maintaining our market weight positioning as we find valuations to be incredibly cheap for some very well financially performing securities. We are closely watching the sectors for signs of a return to favor in the markets or for indications that the financial performance may be slipping. Sector performance deviation continues to be quite high, and we do feel strongly about our current positioning. In our core equity model, we have maintained our overweights to technology and discretionaries. This quarter, we did trim financials slightly and moved that to a fintech company, which increased our overall exposure to technology. Otherwise, our sector weights remain relatively consistent from that of last quarter. Regarding our underweights, I will again bring your attention to those sectors' valuation multiples. Each one of those is between 25 and 30% overvalued based on their historical 20-year averages. And while some of those sectors have had a pretty good year to date, we feel like the valuations are not appropriate for their actual financials and do not justify those returns. As a result, we are continuing to underweight them. In our dividend model, our sector weights remain similar to that of the previous quarter. Due to this model's focus on increased stability and an inherent tilt towards value, there was not a need for any meaningful tactical shifts. Sector and style overlays remain strategic, and we will continue to focus on strong fundamentals and dividend growth. For all of our equity models, should we see problems related to geopolitical events, negative economic data shifts, or earnings growth begin to slow, we will be making a number of tactical shifts, and sector weighting changes will be foremost among those. Moving on to bonds, over the past quarter, the yield curve has moved downward, and the inversion has moved further towards the shorter end of the curve. Past the 3-year maturity mark, the curve has actually steepened, while at the same time moving down with the rest of the curve. So what does any of that mean? And is the inversion a cause for concern? In our opinion, this was to be expected. Once Jerome Powell indicated that the Federal Reserve would do what they need to maintain the current expansion, he encouraged many to believe that rates will be cut in 2019. As a result, the market has priced in this cut, moving the entire curve downward and creating a further inversion on the very short end of the curve. In our opinion, the inversion does not infer that the expansion is ending. Rather, the inversion infers that the Fed is artificially holding the short end of the curve above its natural levels demanded by the markets, and that is about to change. Looking at forecasts for the Fed funds rate, it is clear that the markets expect rates to be cut by 0.75% before the end of the year. Whether or not this is to occur is yet to be seen, but based on the latest discussion from the Fed, it is more likely than not that a rate cut is coming. While we do not think that the economy needs a rate cut, We also don't believe that there is any reason to hold rates at a higher level than investors are willing to accept. This does have the impact of lower yields for bonds, but also offers us and companies much greater borrowing flexibility. Speaking of lower rates, if anyone needs to refinance their mortgage, now is a great time. Mortgage rates are near record lows, with the 30-year rates being around 3.5%. In conclusion, given all available indicators and economic data, we feel cautiously optimistic about what the remainder of 2019 looks like. We feel strongly about the companies we currently own and the way we are positioned going into the next quarter. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarify anything in this presentation. Take care, and we look forward to speaking with you soon.